Welcome back. It's Tuesday here on Squawk Asia, and you're looking at a mixed lead for Asian markets. This day, the Dow was up 78. The S&P added 4. The Nasdaq, though, slipped about 3 points. We had a rally going on the back of stronger than expected manufacturing. That petered out, though, towards the finish. So let's get to our guest host for this hour, Yu-Dee Chang, back with us, principal and also chief trader at Ace Investment Strategist. Love that name. Joins us live out of Washington, D.C. Yu-Dee, a lot going on for this market. This week, we've got payrolls at the end of the week. You've got auto sales as well. On the Euro side, you've got the ECB meeting, plus you got the presidential debates this week. I mean, what is the market going to be grabbing onto, do you think, most?
Well, I think mostly it's probably the ECB rate decisions as well as Friday's employment reports. Basically, the debate itself is going to be what? I think focused probably on U.S. domestic issues, mainly the economy. But I don't think it's going to be a market-moving, deciding factor. I think the ECB rate decision probably will have a little bit positive effect, especially if they come out and ease the rate as expected. Friday's unemployment report, that I think might be market-moving.
Yu-Dee, what do you think markets are going to do in the fourth quarter? October, a notoriously volatile month, but how do you think things are going to wrap up between now and the end of December?
Yeah, I'm actually of the view that in October we will see further downside, believe it or not. I mean, I base this on a lot of reasons. I think, first of all, people are getting complacent. They really are. I'm telling you, Lisa, we talked about a fiscal cliff, and people are saying, no, don't worry about it. They are going to come out with a solution. We're talking about the election. No, election usually don't affect the market in the long run that much. We talked about the fact that, the Fed is going to be there with the Bernanke put, with all this money pumping into the system. We're fine. I see a lot of analysts start going that way. In the beginning of the year, they weren't that way. So I see complacency in the market. Number two, I look at the market fear index. The VIX index is staying right around this 16 low level. And number three, like you were saying, October seasonally is just not a great period for the market. And the fact that the market has just come off a 14% rally since the middle or beginning of June. So by our estimation, overall speaking, I still believe the market is in an uptrend over the month of October. I'm actually remaining to be cautious. I'm expecting a 5 to 8% correction of this market.
Okay, this is kind of interesting. So 5 to 8% pullback for the month of October that we just started. And, if you take a look at, you mentioned the VIX trading in terms of volumes, 2.4 million contracts last month. I mean, this is what investors use to hedge their bets against stock positions. So, I mean, a lot of money's agreeing with you, Yu-Dee.
Yeah, and if you look at today's action, right, so right off the bat, overnight, at least to us, we actually heard Spanish government telling us, well, our banking crisis is not as bad as what you think. And then we got the good ISM report, market bang, start off, right off the bat, such a huge rally. And then middle of the day, people are starting to back off a little bit. Was the analyst downgrade of the Microsoft? So the market action today, and also, Martin, in the middle of the day, when the Dow was up about 100 points, so backing off from 160, the VIX actually turned positive for the day. So a lot of signs telling me this rally is getting a little bit tired. Like I said, overall speaking, I still believe in the uptrend of the market, but short-term speaking, over the next, let's call it 4 weeks, I actually think there's a correction.
Okay, thank you so much. Yu-Dee, stay right there where you are. We'll come back to you in just a few minutes and pick up where you left off and get your exact predictions for the market between now and the end of the year. Let's shift gears for the time. Let's get to Gary Schlossberg now. Gary is chief economist with Wells Capital Management. Excuse me, he is joining us live from San Francisco. And also with us, our guest host, Yu-Dee Chang from Ace Investment Strategist, live from Washington, D.C. Okay, Gary, what did you make of the ISM report? Investors took it as good news, but when you dig into the details, should we be optimistic?
Well, it was certainly a pleasant surprise to get that positive number above 50 on the composite. But you look at the headwinds out there, and it's really difficult to see the economy mounting more acceptable growth in the months ahead, notwithstanding QE3. We did get some improvement, but the orders numbers and some of the other components, including export orders, still below 50 on the index, indicating a contraction. We'll take it for sure, but again, consistent with a generally weak economic recovery.
There was a high reading for employment. Do you think that'll translate into Friday's jobs report?
Well, we'll get a better read on that when we see the ADP employment survey for the private sector later this week, along with the ISM survey for non-manufacturing activity, truly the dominant sector there. Certainly encouraging for the employment report on Friday. But here again, we're just not looking for anything spectacular when you consider the high fuel costs, the weakness in the global economy, those headwinds facing the U.S. going forward. We are the best house in the neighborhood, but very difficult nonetheless.
Yeah, that was well put by Dee. Want you to jump in here, Yu-Dee. What do you think? Can the U.S. keep growing on the manufacturing front when everyone else in Europe, over here in Asia, they're slowing down? Can the U.S. just keep going?
No, I really don't think so. That's why I think it's really the tale of two cities. I think I actually agree with what Bernanke said today, that basically the only savior, we talk about as the savior of the world, is a robust growth. But the point is, how do we get that? Is printing unlimited amount of money the way to do it? I personally disagree with it, but I don't know how to do it. Gary?
Well, there are three venues for quantitative easing. You can get it through exports from a weaker dollar. You can get it from lower borrowing costs, for example, driving the mortgage rate down. You can get it from asset price increases. But when you look at each of those venues, very difficult, I think, to translate into stronger growth from there. I think what we need are lower fuel prices, improvement in the global economy. Europe showing signs that it's getting out in front of its issues to ease concern about the health of the international financial system, and greater visibility on the policy outlook, which probably won't come until after the election. The confluence of those things, I think, could provide better support. QE3, the jury is still very much out.
All right, listen, Gary, stay right there. Also, Yu-Dee, get back to the both of you in just a bit. Questions for either or both of them, email us at squawk@cnbcasia.com. All right, let's get back to Gary Schlossberg, economist at Wells Capital Management, joining us from the other coast of San Francisco. Our guest host stays with us as well, Yu-Dee Chang from Ace Investment Strategist, live out of D.C. Rick was just running through the risk events for the week, non-farm payrolls, auto sales, etc. But I want to ask the both of you, starting with you, Gary, the presidential debates. Is there anything that could come out of those, do you think, that could move markets?
Well, certainly there's a lot of talk that if Governor Romney does well in the debate, that could tighten the whole contest up. At the moment, the president is up on the polls, and there will be a lot of focus on Governor Romney's performance. And that could have an effect on the market, perhaps heightening the uncertainty about the election outcome and, by extension, uncertainties about policy thereafter. Okay.
Yu-Dee, what do you think?
Yeah, I agree. I think right now Governor Romney is actually behind, especially in the swing states. So he really must perform well in the debate in order to turn that around. And if he does, that might have a slight positive effect on the market. But overall speaking, I'm still of the view that debate basically is not going to have an earth-shattering, market-moving effect.
Gary, we had this ISM number coming in surprisingly strong. What if the non-farm payrolls number does the same? Will that give Obama an extra boost?
Well, it certainly can't hurt, the economy being the issue at the moment, and some concern about the economy's weak growth underscored by the Federal Reserve. So if we do get a significantly better than expected jobs number, or perhaps or the unemployment rate dips rather than moving higher as expected, that can't hurt the president, of course.
Yu-Dee, how much pressure do you think the Fed is under to get things rolling again when it comes to the jobs market? Because do you think we're getting close to the point where irreversible damage is being done to the structure of the U.S. economy?
Yeah, I agree. I think Fed is under tremendous pressure, but that's not where the pressure is supposed to be due. I don't think it's Fed's job, actually. I think at the end of it, it's really the government's job. So it's actually the Congress' job and the president's job to get the economy really moving again from the policy side of it rather than just the physical side of it. So Fed has done everything they could do. They're pretty much all in already. I think the next one is on the government.
Gary, do you think the Fed is all in? It doesn't sound like it from what Ben Bernanke's been saying, really defending QE. And what happens when Operation Twist expires? Will it be outright bond purchases from the Fed?
Well, I don't think we're going to see actual draining of liquidity anytime soon, certainly. But I would agree. I think the Federal Reserve is under a lot of pressure to do something. It is a creature of the Congress, in effect. Its independence beholden to the Congress. And I think that has a lot to do with it. But I would also agree that at this point, the Fed seems to be pushing on a string. The venues through which it can stimulate the economy, I think, are questionable at this point. The track record so far has been fairly limited in terms of its impact on growth. We have to look elsewhere for the economy to get that thrust. Some of the things I mentioned earlier, I think, will be more effective.
Gary, as an economist, what are you hoping to see when it comes to the fiscal cliff? I mean, obviously everybody wants a resolution, but will the House Republicans, who have made it so difficult for Obama to get anything through, do you think if they're unsuccessful in making him a one-term president, do you think they'll just lighten up a bit and be a bit more cooperative?
Well, I don't think it's in anybody's political interest to just put the whole thing on automatic and let the economy get hit with the full brunt of any sort of fiscal drag. It's almost certain that we're going to get some sort of compromise. Conventional wisdom is that we'll trim that cliff down, reducing it from 5% of GDP as fiscal drag to something on the order of about 1.5% of GDP. There are a lot of features of that so-called cliff that are likely to be pushed back a bit. And in fact, as we move through 2013, there's a growing sense that the conditions are being laid for some sort of grand compromise on the budget. That's later rather than sooner. The immediate issue is the cliff. We think it will be enough to slow the economy in the first quarter of the year, slow economic growth, but we don't see the full brunt of that cliff hitting early next year.
Hey, Yu-Dee, let's get to some actionable advice for this market. I know that you like gold, a basket of senior miners, but I mean, since the rally in July, haven't these guys ramped up pretty sharply? Are they still good value?
Yeah, I think the gold miners basically really like the price of gold, especially from the period of 2009 till now. Basically, they pretty much forward hedge all their production. I think recently, though, they have come off those hedges. So going forward, if we start to see gold market moving, the precious metals themselves, that is, bullion themselves, that is, if they start to move back to the upside again, let's say going to retest at $1,920 level, then these senior miners are really going to move that. That's why one of the reasons I actually like the gold market. Plus, I've been under the assumption that gold is a heads you win, tail you win market. Economy recovers, inflation down the road, you buy gold. Economy don't, you double dip. Oh my God, you really now have to buy gold to hedge yourselves.
Okay, thank you so much, guys, to both of you for joining us. Gary Schlossberg of Wells Capital Management. We'll say goodbye to him, and we're going to get back with our guest host, Yu-Dee Chang from ACE Investment Strategist, in just a bit. If you have any questions for Yu-Dee, by the way, send us an email. The address is squawk@cnbcasia.com.
All right, let's get on Hilduff, founding partner again Capital, live from our global headquarters in the U.S. And still with us is our guest host, Yu-Dee Chang, ACE Investment Strategist from across live in D.C. John, good to see you. Natural gas, what's going on there?
Well, I think it's a bit of a shorts being caught being too negative on the commodity, Martin. Basically, the nightmare for some that saw these prices get under $2 back in the spring, that required a lot of things. Really, one of the mildest winters we had seen in ever, basically, in terms of degree days, heat demand, volumes and storage that were just so robust that they were practically giving it away in certain local markets. So the prices crashed to near zero. You need all of that to happen again, particularly as you're going into now the heating season, not coming out of it. So a lot of shorts in this market are getting trampled at the moment, and this is a vicious market. It has been over the years. I'd say $3.50 and $4 are on the horizon here in short order.
Yeah, what's going on with energy prices in general? Because oil also surprising and catching a lot of people off guard and really diverging from metals prices. How do you explain that?
Yeah, very much so. From the moment even that the Federal Reserve announced its third round of quantitative easing, that started. It's as if oil has been acting as the conscience of these markets in that it's hewing to or abiding the fundamentals. And abiding the fundamentals of demand destruction that's going on out there. When you look at China, when you look at Europe, when you look at the very reason why the Fed undertook QE3, oil's reacting to that rationale, not to the printing press firing up. So that's why it's been going down. And it even took a greater shudder in this market when the Bank of Japan somewhat surprisingly outlined and announced its own stimulus. It's as if now this race to the bottom really highlighted and cemented the view that oil demand's going to be soft here going into the next couple of quarters. And so the price has corrected, I think, reasonably so.
Yeah, John, you know what? Over the short-term basis, I really agree with everything you said. But if you look at, basically over the intermediate term, the price of oil has volatility, we joke around saying volatility gone nowhere. Basically, it's been oscillating between 80 to 110. Don't you feel there just are too many cross-current to make the oil market to have a sustained movement toward one direction?
I think that's right. We've broken down really over the past, I'm going to call it year now, a couple of times right around the $80 level, as you point out, and we've reversed viciously twice up towards 100, where we've similarly failed. I think, though, that this time around looks like it might be different to court trouble by saying that. But I do think that the pressure to the downside is going to be on here. Principally because of the weakness we're seeing coming out of China and its main market, Europe, sort of feeding on each other. And China, the way Saudi Arabia is the swing production center, as I like to say, China's that swing demand center. If their numbers continue to come down, I really don't believe there's any way oil can hold the $80 level here in the U.S.
Yeah, Yu-Dee, I got an energy-related question for you. You brought up the volatility and price spikes in energy. The kinds of cycles or phases in a cycle that we see in that sector, trending, counter-trending, consolidation, you think you can make, or an investor can make money in any of them. What phase are we in now, and how do we make money?
Yeah, you know what? If you ask me, I believe the price of energy is in the consolidation phase. Natural gas notwithstanding, I would agree with John there. That is a start to in the bull market. But the price of oil itself, we believe it's not going to go anywhere. I mean, on one hand, everything John said, I agree. But on the other hand, there are geopolitical risks, and maybe China will hold that 7.5% growth. So there's a lot of factors affecting that market. Basically, it's not going anywhere. So we've been able to use an alternative strategy for the past 18 months and been getting pretty good results trying to play that range. And in the foreseeable future, that's what we see. We continue to see the price of energy basis the oil probably still between about $70 a barrel to about $110 a barrel.
Okay, thanks to both of you for that chat about commodities. Goodbye to John Kilduff from Again Capital, and we're going to get final thoughts in just a moment with our guest host, Yu-Dee Chang from Ace Investment Strategists. You can still send over questions, by the way. There's still time. The address is squawk@cnbcasia.com, or you can get me on Twitter. My handle @LisaCNBC. In our countdown to trade here in Asia, a lot of focus on manufacturing data, as Kayla just mentioned. The ISM number in the United States, surprisingly better than expected. Sent the markets up for a little bit, and then investors thought twice about it and decided to pull back. And Dee, we also had numbers out of China almost made the 50 mark, but not quite.
That's right, Lisa. And it's kind of strange, right, to have an expansion in the U.S. and actually more contraction in China. And when you look at the activity over the last year, it's nearly a year of declining business activity. And the world's second largest economy is supposed to be the engine, the global engine of the economy. So really disappointing. That could weigh on some of the data we see out of China.
They were supposed to be picking up where the U.S. left off, weren't they? Yu-Dee, I want you to jump in here. How should investors be trading today? What's your advice?
Well, I think be trading today is really on the short-term basis. I keep saying this. On the short-term basis, I believe there are some weaknesses in the market, whether because of continuous weakness in China, or whether because of the U.S. uncertainties, or whether because of the debacle of continuous European problems. So short-term basis, I will actually raise some cash and get ready to buy the dips. I personally am expecting a 5 to 8% correction. So now, for the more aggressive, I guess you could buy the VIX index. You can actually short the market indices, or maybe even sell some calls. So there's a lot of ways to take advantage of the potential or the possible correction in this market here.
Okay, what about those hedge funds that are trailing their benchmarks? They had so much money, more money flowing into them actually than the year before, but most of it was focused in bonds. We had the run-up in equities. Very quickly, do you think that could skew trade for the rest of the year?
Yeah, I think that definitely could do it. And that's hence the so-called risk trade and Bernanke's concept of keeping rates low to push this market into riskier investments. I think so. After the correction, I'm actually will be a buyer of this market, looking forward to continuously going higher. I agree with what you said. That's exactly the risk trade.
Okay, thank you so much, Yu-Dee, for being our guest host. We appreciate it.
Thank you.
That was Yu-Dee Chang there of ACE Investment Strategist joining us. And we're going to continue to count you down to the open